Okay, so you want to own an insurance company. You've watched the premiums flow in. You've heard the name Warren Buffett spoken in the same breath as the word float. You've done the rough math. Hundreds of thousands of customers, each paying $500 a year, and you're sitting on a mountain of cash before you've paid out a single claim. You collect money now. You pay it out later, maybe never. The business practically runs itself. That is the fantasy. Here is the reality. The most profitable insurance companies in the world operate on underwriting margins so thin they're measured in fractions of a percent. Entire lines of business routinely lose money every year, on purpose, because the real game isn't premium collection at all. Most people who own an insurance company don't actually understand what they bought, and the ones who figure it out too late don't get a second chance, because insurance regulators have already seized their assets and paid off their policyholders. This video is about what it actually costs to start and run an insurance company, what it actually earns, where the money really comes from, and why the structural trap built into this business has destroyed intelligent, well-capitalized people who thought they understood the math. Before we touch a single number, we need to reframe what an insurance company actually is. Because if you think it's a business that sells protection, you've already misunderstood it. An insurance company is an investment fund that uses other people's fear to generate investable capital. That's it. The premiums aren't revenue in the traditional sense. They're temporary liabilities. You collect them, you hold them, and you owe them back in the form of claims. The actual product you're selling is the promise to pay. But what you're actually doing between collecting that premium and paying that claim is investing the spread. The underwriting business, the policies, the premiums, the claims, is the engine that keeps the fuel flowing. The investment portfolio is where the money actually gets made. Keep this distinction in mind for everything that follows. It changes how every number in this business needs to be read. Let's start at the beginning, the cost of entry. You cannot simply decide to sell insurance policies. In the United States, insurance is regulated at the state level, and every state has a Department of Insurance that licenses, supervises, and can liquidate carriers. To form a licensed insurance company, called an admitted carrier, you need to demonstrate to regulators that you have enough capital to pay anticipated claims, cover operating expenses, and survive adverse conditions without going insolvent. That minimum capital requirement is called the Risk-Based Capital Standard, or RBC. The National Association of Insurance Commissioners sets a framework and states adapt it. For a small, single-state property and casualty insurer writing personal auto and homeowners policies, you're typically looking at a minimum surplus of somewhere between $3 million and $10 million just to get a license. That's before rent, before technology, before staff, before a single policy is sold. If you want to write across multiple states, which you'll need to do to scale efficiently, multiply that complexity dramatically. Each state has its own licensing process, its own filing requirements, its own rate approval procedures. Industry consultants estimate that a new carrier seeking admission in 10 to 15 states should budget between $500,000 and $1.5 million in legal, actuarial, and regulatory filing fees alone, spread over 12 to 36 months before writing $1 of premium. Mid-size ambitions cost more. A regional carrier targeting commercial lines, business liability, workers' compensation, commercial auto, may need $20 million to $50 million in initial capitalization to meet RBC requirements, establish reinsurance relationships, and convince distribution partners like independent agents that you're stable enough to trust with their clients. Large national carriers or specialty lines companies, we're talking $100 million plus in startup capital, sometimes significantly more, depending on the lines of business. Berkshire Hathaway's Geico operation had assets of over $30 billion. You are not starting there. But understanding that scale shows you the ceiling of what this business can become, and the distance between where you start and where the profits actually get reliable. Now, the hidden pre-launch costs. This is where new entrants consistently underestimate their burn rate. First, actuarial certification. Before any regulator will approve your rates, you need a credentialed actuary, a fellow of the Casualty Actuarial Society or equivalent, to sign off on your loss reserves and rate filings. Hiring a full-time chief actuary for a small carrier costs $250,000 to $400,000 annually. Contracting actuarial services to an outside firm runs $100,000 to $300,000 per year, depending on volume. Second, reinsurance. This is the insurance that insurance companies buy. You cannot write policies without it because your risk is too concentrated. A single catastrophic event, one tornado, one wildfire, one large liability judgment, can generate losses that exceed your surplus and render you insolvent. Reinsurance agreements typically require cedents, that's you, the primary insurer, to pay premiums ranging from 10% to 30% of your gross written premium, depending on the lines you write and your loss history. For a startup with no history, reinsurers price you at the expensive end. Budget 20% to 25% of gross premium in your first few years, going straight back out the door. Third, technology. Modern insurance operations require policy administration systems, claims management platforms, billing systems, and increasingly, underwriting automation. Licensing a mid-tier insurance core system, companies like Guidewire or Duck Creek Technologies dominate this market. Cost between $500,000 and $3 million annually, depending on your scale. Building something proprietary costs more, takes longer, and rarely works better. Fourth, distribution. You need agents or direct channels. Independent agent commissions typically run 10 to 15% of premium on personal lines, 12% to 20% on commercial lines. If you're going direct to consumer, you're spending on marketing instead, and digital customer acquisition costs in the insurance space average $400 to $900 per new auto policy, according to industry research from McKinsey. Neither path is cheap. Add it all up, and the honest pre-revenue burn for a small to mid-size admitted carrier is $5 million to $15 million before you've collected enough premium to cover your own operating costs. Most startups underestimate this by half. Now let's talk about how an insurance company actually makes money. There are 4 distinct revenue layers, and they don't all work the same way. Layer 1. Net earned premium. This is the gross premium you collect from policyholders, minus what you pay to reinsurers. If you write $50 million in gross premium and cede 20% to reinsurers, you're left with $40 million in net earned premium. That $40 million is spread over the policy period, typically a year, and recognized as earned revenue as time passes, and the risk you assumed goes by without claims. This is the top line of the business. It looks impressive. It is not the profit source. Layer 2. Underwriting gain or loss. This is what remains after you subtract claims and loss adjustment expenses, LAE, the cost of investigating, litigating, and paying claims, from your net earned premium. The ratio of losses to premium is called the loss ratio. Industry averages for U.S. property and casualty insurers hover around 65% to 75%, meaning for every dollar of premium, 65 to 75 cents goes back out in claims. Add another 25% to 30% for operating expenses, agent commissions, administrative overhead, technology, and your combined ratio, which adds your loss ratio and expense ratio, often exceeds 100%. A combined ratio above 100 means you lost money on underwriting. This is extremely common. The Insurance Information Institute reports that U.S. P&C insurers ran a combined ratio above 100 in multiple years of the past decade, including 2017, driven by Hurricanes Harvey, Irma, and Maria, 2020, and again in 2022 and 2023, as inflation drove loss costs sharply higher. This is not a bug. It is almost a design feature. Which brings us to Layer 3. Layer 3, investment income. This is where the business model actually lives. Between the moment you collect a premium and the moment you pay a claim, which could be 6 months, 3 years, or a decade for long-tail liability lines, you hold that money and invest it. The industry term for this pool of investable funds is the float. Warren Buffett has written about Berkshire Hathaway's float so extensively that it has become one of the most discussed concepts in value investing. As of Berkshire's 2023 annual report, their insurance float exceeded $168 billion. They essentially borrowed that money from policyholders at zero cost, sometimes at a negative cost, when underwriting profits partially offset losses, and invested it across decades. For a smaller carrier, investment income is still critical. A regional insurer with $200 million in invested assets earning a 4% yield generates $8 million in investment income annually. That income can convert a modestly unprofitable underwriting year into a profitable overall year. The investment portfolio isn't a side hustle, it's the engine. Layer 4. Fee income and other revenue. Many carriers earn ancillary revenue from policy fees, installment billing charges, and in some cases, managing third-party policies as an administrator without assuming the underlying risk. These fees are smaller in aggregate, typically 2% to 5% of total revenue for most carriers. But they're high margin because they don't generate claims. Now the operating costs. And here is where the fixed cost trap becomes visible. A licensed insurance company has a floor of fixed expenses it must pay regardless of how many policies it sells. Regulatory compliance, actuarial review, technology licensing, minimum staffing for claims handling, legal costs, audit fees. None of these scale down when volume drops. Industry analysts estimate that the fixed cost base for a small admitted carrier runs $3 million to $7 million annually before a single variable cost is added. Variable costs, primarily claims and agent commissions, do scale with volume. But here's the structural mismatch. Your revenue is capped in the near term by your premium pricing, which in most states must be filed with and approved by regulators before you can change it. If inflation drives your claims costs up 15% in a year, which is precisely what happened to auto insurers between 2021 and 2023 as used car prices and repair labor costs spiked, you can't immediately raise rates to compensate. You have to file, wait for approval, and implement. That lag can last 6 to 18 months depending on the state. Meanwhile, your loss ratio is bleeding upward, and your combined ratio is moving well past 100. This is not a theoretical scenario. This is what happened to dozens of regional carriers and sent several of them into insolvency between 2022 and 2024. Let's talk about the structural risk specific to this business. The one most people who study insurance still underestimate. It's called reserve inadequacy, and it is the quiet destroyer of insurance companies. When an insurance company pays a claim, it's usually not immediate. There's an investigation, sometimes litigation, and for certain lines, workers' compensation, medical malpractice, general liability, claims can remain open for years or decades. During that time, the carrier must estimate what it will ultimately pay and set aside a reserve for it. Those reserves are set by actuaries. They are, by definition, estimates. And if those estimates are wrong, if the actuary assumed that claims would settle for less than they ultimately do, or that certain liabilities would expire when they don't, the company is holding less capital than it actually owes. This matters for a specific, terrifying reason. Reserve deficiencies are often invisible for years. An insurer can report profitable underwriting results, distribute dividends to its holding company, and attract new investors, all while quietly sitting on a time bomb of under-reserved liabilities that won't detonate until claims mature. The National Association of Insurance Commissioners uses a financial analysis tool called the Financial Analysis Solvency Tools, FAST, score, to flag early warning signs of reserve stress. But by the time a company appears on a watch list, the damage is often already done. Reserves are not merely an accounting line. They are the business's honest answer to the question, what do we actually owe? When that answer is wrong, everything downstream is wrong with it. Here is a real example. Executive Life Insurance Company was one of the largest life insurers in the United States in the late 1980s. It was founded in 1947 and by 1990 had over $10 billion in assets and more than 300,000 policyholders. It was also heavily concentrated in one asset class, junk bonds. Executive Life's investment portfolio was roughly 60% high-yield bonds at a time when the junk bond market was booming. The yield was exceptional. The investment income was exceptional. The company looked, by almost every surface metric, extraordinarily profitable. Then the junk bond market collapsed in 1989 and 1990 as the savings and loan crisis deepened and Michael Milken's empire at Drexel Burnham Lambert disintegrated. Executive Life's portfolio lost roughly $2.5 billion in market value in under 2 years. In April 1991, California Insurance Commissioner John Garamendi seized the company, the largest insurance insolvency in American history at that time. More than 300,000 policyholders faced delayed payments, reduced benefits, and years of litigation before their claims were resolved through the California Life and Health Insurance Guarantee Association. The failure was not caused by bad underwriting. The underwriting was unremarkable. The failure was caused by concentration risk in the investment portfolio, the very portfolio that was supposed to be the profit engine of the business. The float had become a liability. Let's run the numbers side by side. A good year versus a bad year for a mid-size regional property and casualty carrier. Let's say one writing $100 million in gross written premium across 3 states in homeowners, personal auto, and small commercial lines. In a good year, you cede 20% to reinsurers, leaving $80 million in net earned premium. Your loss ratio comes in at 62%, below industry average, thanks to a mild weather season and disciplined underwriting. That's $49.6 million in losses and loss adjustment expenses. Your expense ratio is 28%, another $22.4 million in operating costs. Combined ratio, 90%. Underwriting profit, $8 million. Your $180 million investment portfolio, assets accumulate over time, earns 4.2%, generating $7.56 million in investment income. Total operating income, approximately $15.5 million. After state premium taxes of roughly 2.5% on gross written premium, that's $2.5 million, and federal income tax on investment income and underwriting gains at a blended effective rate of around 21%, you net approximately $10 million after tax, on $100 million in gross premium, a 10% net margin. That is a very good year. In a bad year, a regional hurricane or severe convective storm season adds $15 million in catastrophe losses above your reinsurance retention. Your reinsurers pay above the threshold, but your net retained losses spike your loss ratio to 82%. Combined ratio, 110%. Underwriting loss, $8 million. Your investment portfolio, now under rate pressure because you had to sell some assets to fund claims, earns 3.5%, $6.3 million. Subtract the same $2.5 million in premium taxes. Subtract regulatory fines of $400,000 for a claims handling delay that triggered a state enforcement action. Subtract $1.2 million in rate refiling and actuarial costs to restructure your pricing after the loss event. Before income tax, you're at a loss of approximately $5.8 million. After any partial tax benefit, your net loss for the year is approximately $4 million. The difference between those 2 years is $14 million. Same company, same premium base, same management team. The gap is weather, lag, and leverage. So why do sophisticated investors still buy insurance companies? Why does Berkshire Hathaway keep acquiring them? Why do private equity firms pay premium multiples for regional carriers with mediocre combined ratios? 3 reasons. First, float duration. A well-run insurance operation generates investable float for decades. That float, properly invested, compounds in ways that dwarf the operating business itself. Buffett has estimated, and academic finance research has confirmed, that the Berkshire float has cost less than zero over time, meaning underwriting profits have actually partially subsidized the cost of capital. No bank, no bond, no other financial instrument gives you $50 billion in borrowed capital at a negative carry. That is a structural advantage available only to insurance companies. Second, tax efficiency. Insurance holding companies can, under certain structures, accumulate investment gains in ways that defer or reduce federal tax liability. They also generate deductible loss reserves that reduce taxable income in high-loss years. For a high-net-worth family office or a corporate acquirer with long-horizon investment objectives, an insurance company is partly a regulated investment vehicle wearing an operating business disguise. Third, barriers to entry are real and durable. Regulatory capital requirements, state licensing complexity, actuarial data requirements, and distribution network construction make insurance an extraordinarily difficult business to disrupt from the outside. A carrier that has operated in a state for 20 years has lost data, agent relationships, and regulatory standing that no startup can replicate in 2. That incumbency is worth money, sometimes a lot of money. Here is what you actually need to understand about this business. Everyone who buys an insurance company thinks they're buying a cash machine that runs on fear. They're not. They're buying a liability promise attached to an investment engine, wrapped in one of the most complex regulatory structures in American commerce, dependent on actuarial estimates that may not be proven right or wrong for 10 years, and exposed to catastrophic events that no model fully anticipated. The insurance companies that fail don't fail because they ran out of customers. They fail because they mispriced risk, under-reserved claims, or over-concentrated their investment portfolio, and discovered it years after the decisions were already locked in. The ones that thrive don't thrive because they collect more premiums than their competitors. They thrive because they understand something that outsiders almost never grasp. In this business, $1 of float is worth more than $1 of profit, because $1 of float is investable today, compoundable for years, and only conditionally returnable. The policy promise is the cost of access. The portfolio is the point. Warren Buffett said it plainly in his 1994 letter to shareholders. Insurance is the business of accepting other people's risks for a fee. But what he understood, and what most people who read that sentence don't, is that the fee is almost secondary. The risk, properly structured, is the asset. You don't own an insurance company because you want to collect premiums. You own it because you want a legal, regulated, durable mechanism to hold other people's money for a long time and invest it better than they can. Everything else is paperwork.